The human mind is possessed by a deep and powerful instinct, the desire to find a bargain. In nearly every field of commerce, the man who buys a quality item at a low price is considered shrewd and successful. It is this very instinct, so useful in ordinary life, that becomes a fatal and ruinous flaw when applied to the art of stock speculation. The Wall Street bargain counter is where the hopes of the amateur are displayed, and where his capital is laid to rest. The master speculator, whose craft is a science of probabilities and not a game of chance, understands a truth that is profoundly counterintuitive to the novice. He knows that the speculator's job is not to buy stocks as cheaply as possible, but to buy them at precisely the correct time. That time, more often than not, is not when the stock is at its lowest price, but when it is at its highest. This is the great paradox of the market. The amateur, governed by his bargain-hunting instinct, is irresistibly drawn to the low-priced stock, the one that has fallen from grace and looks cheap. The professional, governed by the cold logic of the ticker tape, is drawn to the high-priced stock, the one that is making new highs and is demonstrating its own undeniable strength. This is not a matter of opinion, but of a lifetime of observation and costly experience. Jesse Livermore, through a career of immense victories and devastating losses, forged this principle into the very bedrock of his operational philosophy. One must avoid cheap stocks. They are a siren song, luring the hopeful speculator onto the rocks of financial ruin. The lessons and the stark logic behind this philosophy were documented with unparalleled clarity by Edwin Lefèvre in his timeless chronicle of a master speculator's mind. For any student who wishes to move beyond the amateur's guessing game, this text is indispensable. A link to Reminiscences of a Stock Operator can be found in the description below this video. To understand why a master avoids cheap stocks, one must first dismantle the amateur's flawed definition of the word cheap. The novice looks at a stock trading for $10 and calls it cheap. He looks at a stock trading for $100 and calls it expensive. He is judging the merchandise by the price tag alone, a fatal error in this business. The nominal price of a stock is an utterly meaningless figure. It tells a speculator nothing about a stock's true value or its potential direction. A $10 stock that is on its way to $1 is fantastically expensive to the man who buys it. A $100 stock that is on its way to $200 is an incredible bargain. A stock's price must never be considered in isolation. It must be considered only in relation to its trend, its behavior, and the path of least resistance. The speculator's job is not to buy a low number, but to buy into a powerful, upward-moving force. The professional's definition of cheap is therefore a stock that is in a confirmed uptrend, a stock whose own action on the tape proves that the line of least resistance is upward. Conversely, the truly expensive stock is the one whose price is falling, for in buying it, one is paying the high price of betting against the established trend. This leads to the great law of leaders and laggards. Any major movement in the stock market is not a chaotic, uniform advance. It is a highly organized campaign, led by a small handful of powerful industrial groups, and within those groups by an even smaller handful of elite leading stocks. These leaders are the generals of the market's army. They are the first to emerge from a period of dullness, the first to break into new high ground, and the ones that advance with the greatest power and velocity. The big, safe, and profitable money is always to be found in these leaders. The Laggards are the second-tier, lower-priced stocks in the same group. They do not lead the advance, they follow it, often much later and with far less power. They are the weak soldiers at the back of the army. The amateur, looking for a bargain, is always drawn to these laggards. He sees that the great leader of the group has already advanced 50 points, and he concludes it is too high. He then looks at the sluggish, low-priced laggard that has only moved 5 points and decides it is cheaper and has more room to run. He is making a fundamental and costly error in judgment. He is choosing to place his capital not on the proven thoroughbred but on the slow, tired plow horse, hoping that it will somehow win the race. The market is a game of performance, and the speculator must align himself with the proven performers, not the hopefuls. The psychology of the bargain hunter is a psychology of fear. He is afraid to buy the leading stock at a new high because it feels risky, it feels exposed. The high price intimidates him. He feels safer buying the beaten-down stock at a low price, for he mistakenly believes it has less distance to fall. Livermore knew this logic to be completely backward. The stock that is making a new high is doing so because it is intrinsically strong. The market, in its collective wisdom, is bidding it up. It has proven its power. The stock that is selling at a low price or that has had a great fall has, by its own action, proven that it is weak. The speculator's job is to go with the tide, not against it. To buy a stock that has demonstrated its weakness is to bet on a reversal of the tide. This is a low probability, high risk wager based on hope. To buy a stock that has demonstrated its strength is to align oneself with the powerful established current. This is the path of the scientific speculator. The one true and final arbiter in this matter is the principle of the line of least resistance. The speculator must train himself to see this line in the action of a stock. It is the direction of the predominant pressure, either buying pressure or selling pressure. A cheap stock, a stock that is low in price and has been declining, is a stock whose line of least resistance is demonstrably downwards. There is an oversupply of stock for sale, and not enough buying demand to absorb it. The path of least resistance is the path to lower prices. To buy such a stock is to attempt to stand in the way of a powerful downward moving force. It is to try and catch a falling knife. The chances of success are slim, and the risk of injury is great. A leading stock making a new high, by contrast, is one whose line of least resistance is demonstrably upwards. The supply of stock has been absorbed, and the buying pressure is now dominant. There is no overhead resistance from old trapped buyers. The path is clear for a major advance. To buy this stock is to step into a powerful upward moving current. The force of the trend itself will help to carry the position forward. This is the difference between fighting the market and having the market as a powerful ally. The bargain hunter will often try to justify his purchase of a cheap stock by pointing to its fundamentals. He will say that the stock is selling for less than its book value or that its earnings are sure to improve. He is an investor, he tells himself, not a mere speculator. Livermore had no patience for this line of reasoning. He was a speculator, and his one and only concern was the action of the stock on the ticker tape. The tape was the final authority, for it represented the sum of all knowledge and all opinions of every person in the market. If a company had a wonderful balance sheet and a brilliant future, but its stock price was steadily declining, the tape was telling a clear story. It was saying that the insiders, the smart money, the people who truly knew the company's prospects, were selling. To ignore the verdict of the tape in favor of one's own analysis of a financial statement is a form of intellectual vanity that is always punished by the market. The speculator must trust the action of the stock over the story about the stock. If a stock does not act right, the reason does not matter. The fact of its weakness is the only thing that is important. There is a specific and highly dangerous phenomenon associated with cheap stocks that the master speculator is always vigilant to avoid. It is the sympathy move. This occurs late in a great bull market, after the true leaders have already had their spectacular advances. The public, having missed the main move, becomes wild with speculative fever. They begin to hunt for the next big thing. They turn their attention to the laggards, the low-priced, poor-quality stocks in the same groups as the leaders, and they begin to buy them indiscriminately. This rush of public buying will often cause these cheap stocks to have a brief, sharp, and exciting rally. This is the sympathy move. The laggards are finally moving, not because of their own strength, but in sympathy with the general bullish excitement. Livermore knew this to be the final terminal stage of a bull market. It was the market's way of distributing the last of the poor quality merchandise to the hopeful and unsuspecting public. These sympathy moves are treacherous, and they often end in a sudden and catastrophic collapse. The professional is not participating in this late-stage gamble. He has already taken his profits in the leaders and is standing aside in cash, watching the amateurs rush toward their inevitable doom. The first sign of strength in the cheap stocks is often the final sign that the end of the entire bull market is near. The true mark of a leader, the proof of its strength, is its ability to make a new high. This is one of the most counterintuitive and yet most profitable of all speculative principles. The amateur is afraid of the new high. The professional welcomes it as the ultimate confirmation. The new high is the stock's declaration of independence. It is the proof that it has overcome all the old selling pressure, all the overhead resistance, and is now entering clear, open territory. It is the most bullish signal a stock can give. To buy a stock as it is making a new high is not to buy at the top, as the amateur fears. It is to buy at the very beginning of the next, and often most profitable leg of the advance. It is the very definition of buying at the pivotal point, the moment of least risk. The speculator must have the courage to buy the stock that looks too high and the discipline to avoid the one that looks too cheap. This requires a complete reversal of the ordinary, common-sense instincts that govern human behavior in every other field. One must also consider the hidden costs of trading cheap stocks. The first cost is the most obvious: the direct financial loss that comes from betting against a downtrend. But there is a second, and perhaps greater, cost. This is the opportunity cost. The capital that a speculator has tied up in a cheap, sluggish, and declining stock is dead capital. It is imprisoned. It is capital that cannot be used to take a position in the powerful, fast-moving leader that is actually making money. The speculator not only loses money on the poor stock, he also loses the immense profit he could have made on the good one. This is a double loss, a grievous strategic error that the professional never allows himself to make. A cheap stock also exacts a heavy psychological price. It is a constant source of worry, of doubt, of frustration. It saps a speculator's mental energy and erodes his confidence. A leading stock, by contrast, provides an immediate profit, which is the greatest of all confidence builders. In the final analysis, the entire philosophy can be distilled into a single, unchanging law of speculation. One must always follow the leaders. One must buy strength, not weakness. One must align one's capital with the most powerful and constructive forces in the market. The stock market is not a department store where the shrewd shopper looks for discounted goods. The bargain table on Wall Street is where the defective, the unwanted, and the failing merchandise is placed. It is a place for fools, and for those who are about to become fools. The highest quality merchandise, the stocks with the greatest potential and the soundest prospects, are never found on the bargain table. They are always the ones commanding the highest prices, the ones making new highs, the ones that the amateur is too timid to buy. The speculator must train himself to overcome his natural human instinct to buy things cheaply. He must learn to be a connoisseur of quality, of strength, and of leadership. He must develop the professional habit of buying dear in the expectation of selling dearer. This is the path. It is not an easy one, for it requires a man to act against his own ingrained instincts. But it is the one true path that has been proven by a century of market action. The great enduring fortunes are built not upon the shifting sands of cheapness, but upon the solid rock of demonstrated strength.